My name is Ben Shenlin from Zhejiang University of a different country and different colony, which is China. And I'm privileged and honored to be the host and chair of this session. We have a distinguished group of discussants and panelists. And I will just start doing a bit of introduction. From my closest side is Krish, the famous Krish from HSRC, the chief researcher, Krish Shabby. Krish. Then next to them is Dr. Wenwei Li, is part of Academy of Internet Finance, Zhejiang University. Also is a postdoctoral student fellow at Shanghai Gold Exchange. And then we have the famous Patrick. Yeah. Then we have the famous Patrick. Yeah. Patrick is the CEO of one of the fintech companies in Kenya, where we just spent 4 days. Very good. We got, wow, I didn't get your name. Fiona. Fiona is the director of Sustainable Digital Finance Airlines. And then you work with UN and with Jack Ma and Financial, which is our neighbor. 跟蚂蚁政府跟马云是共同他们联合国的做这个可持续金融。Okay. And then we have, oh, sorry, I think you gave me Kim. Yes. Again, from the beautiful, amazing African country, which is, Kenya. Eastern Africa. Our group actually spent about 4 days in Kenya before we came to South Africa. And then on Kim's right is Dr. Yüksel. Yüksel Gomez. He's from the Central Bank of Turkey. But his other title is he's a senior research fellow of Academy of Internet Finance as well. Okay? And further to the farthest is Mr. Yifu Liu from Lian Pay. You probably have heard of Alipay or WeChat Pay, but Lian Pay is one of the leaders in China as well. So they are a partner for a project called FINTECH, the African project. So all of you, welcome. Okay. Today we have 2 parts for this session. And I think Dr. Juicy, as usual, he wants to make me work extra hard, okay? So we have the first part will be talking about 2 things we're going to launch today here. And that will also, basically serve as a teaser for our discussions. So what I will do is talking about bank internationalization, as well as the FinTech, especially the Global FinTech Hub Index report that we are releasing today, together with HSRC. Okay. So first and foremost, the so-called banks, are we becoming more global, or are we becoming a bit less global, given anti-globalization, given unilateralism? So that's what the project we have been working for the last 4 years. The banks, are they becoming more global? So east or west, what we call the home is best, that's a question mark. We have a few books, and which is In Pursuit of Presence or Prominence, talking about the Chinese banks, globalization, and their global benchmarks. So we're not just limited to Chinese banks, how global they are becoming, but more importantly, how they stack up against global leaders. And of course, there are some Chinese versions, and we didn't have enough time to do that in English. So what I will do today for this part is really about talking about the index, the Bank Internationalization Index, how we came up with the index. And secondly, we'll talk about the rankings and how they stack up against each other globally. And thirdly, we'll talk about a couple of cases since we were in Africa, a couple of African leaders in terms of globalization. First and foremost, how did we come up with the BII, 银行国际化指数, Bank Internationalization Index? We look at things from three dimensions. First, basically, is about their presence. How many people do you have overseas? How many branches do you have outside your home country? And how big is your, basically, how many countries you're operating outside your home country? And the second part, we talk about really how much investment you have made. I hope it's on. It is on, right? Okay. Secondly, we talk about how much investment you have made. That means the overseas assets and how much loans you have extended outside your home country. And third way, we look at how effective you are managing your international operations. That means, are you making money? How much revenue you are making outside your home country? So these are the three dimensions we look at the BII. And the data we use are a lot. We look at the 19 countries. Last year. This year will be more. Actually, we're going to release the latest report in September. But last year we calculate 49 banks across 19 countries. 14 are developed countries, but 5 are, as you could imagine, BRICS countries, including South Africa. We use 10 years data, so not just single year, 2 years, 3 years. We use a lot of data, and we look at the developed and developing countries. And this is the global trends, as I mentioned. For example, for the 49 banks we have done, you can see the 3 lines. The red line is really the emerging markets or the developing markets, the 5 countries, BRICS countries. And the index is such, 100 means you are totally offshore, totally global. You don't have any home country operations. Everything else everything done is outside your home country, but which is usually isn't in existence. Okay. But if it's 0, if you are a pure domestic institution, your BI is 0, basically. So if you look at the emerging markets banks, you would see that the red line, as of say 2016 data, it's about 10 out of 100, but it's increasing from like 10 years ago, which is about half the amount. And if you look at the developed markets, which is the blue line, you will see it's pretty stable over the last 10 years, about 35, around that, 35 out of 100. And the blended, obviously, is the total 49 banks, the weighted average, how international they are. And this is a specific country ratings based on the 49 banks, which country they belong to. For example, Spain ranks number 1, actually, because Santander is very global outside Spain. They are very active in Latin America, in UK, for example. And Germany, the Deutsche Bank, is 54. And Switzerland, you have 2 banks, it's 53. And the US, actually, in our sample, we have 6 banks. In US, average is like 28. While the UK is pretty high, 44. And then if you move further down, it's the red ones. It's really the China, Brazil, India, the BRICS. What you will see is that, for example, South Africa, we have 3 banks. On average, is 15. Yeah. And in Russia, 2 banks is 15 as well, roughly. And China, we have 2. One is China's Big 4. ICBC, Bank of China, they are like 14. But in the top 10 banks would be like a 7.6. Brazil, we had 1 bank, it's 3. And India is 13 with 4 banks. And these are the specific bank ratings or rankings. On the left are the developed countries, and on the right are the developing countries. And what you see is very interesting. Surprise, Standard Chartered Bank is the highest in the developed market, 67. And when we were traveling in Kenya, in Africa, Standard Chartered is there. And also Standard Chartered, as many of you know, their home country, registered office is the UK, but they almost have nothing. They almost have nothing in UK. So that's why they're pretty high. While the HSBC is pretty high, I worked for them. And Citigroup, 51, for example. It's pretty high, but not as high as we thought. That's because the home market is big. The home market is big. And if you look at, say, further down, like Mitsuko, which is a Japanese bank, 27, number 20 in this case as well. While on the right, what you see is that the developing countries, the first one is Bank of China, but it is inflated number, 26. The reason I say we were cheating a little bit is because we consider Hong Kong operation Bank of China as the international operation. So if we remove that, I think the Standard Bank of South Africa would be the number one, the most global bank in developing countries. And we were traveling Africa, we can see that, okay? And then, of course, if you look at further down, you will see a few other banks, like State Bank of India, it's 11. And Bradesco from Brazil is 3.75. And the first rent bank, it's 11. I think it's from the local banks here as well. Okay. So coming to our home market here, which is African banks, the three. As I said, among the 49 banks, in our sample, Standard Bank is ranked number 26 with an index score of 20.6. And their overseas revenue, for example, represent about 31%, which is pretty high. Pretty high. And they operate in 20 countries, while if you look at the net bank, the score is similar to the other bank, or first rank is about 11, 12, and the rankings is like 35, 36 among the 49 sample banks that we have. Okay. And you could see that, for example, net bank, operating countries is 39 actually. Higher number of countries, but still overall score is lower than, say, Standard Bank because the revenues and other dimensions. So what are the key takeaways? First and foremost, in today's globalization or anti-globalization, you will see that the gap between developed markets and the developing markets are narrowing, even though it's still significant. Average is like 3.5 times of developing markets banks, so-called BII. Okay. And in terms of the future, I would think three factors would affect really the future globalization or internationalization level. One is anti-globalization sentiment or unilateralism. That's one of the reasons why the developed markets, the banks, have not really been expanding their international operation. Secondly, I think the anti-bank sentiment. I personally was a banker, and I didn't realize we had such a low social esteem. Okay? And people say, well, banks are really not helping as much as we would like to see. So we all probably wouldn't mind if banks disappear one day, right? So that's what's happening. The third one, I think, is the FinTech. FinTech is going to change how financial services are conducted. So it will also change the way the banks are going to start their international operation in a different country. For example, ING from the Netherlands, they are in Germany, but with only one single license, single branch. Direct banking, they are one of the top 5 banks in Germany already. So it's happening. So this is on the first part of my launch. Okay, do you see? You buy one and get one free. Okay, the second one is about fintech. Okay. Fintech. This is something that, as I said, it's dear to my heart, and we are trying to share with you the global fintech, hubs, how they are stacking up. In the previous session, we were talking about whether the Western countries are dominating. Is there any area that we might be able to leapfrog or disrupt the existing world order? And that's what we are trying to evaluate. So what I will do is talking about the global fintech hub index again, trying to measure them. We'll talk about the index system, talking about how we calculate, and second, we'll talk about the global landscapes, the fintech hubs worldwide, which will probably give you some surprise, and the city ranking, specific city ranking. And then we would, if the time is right, I will do some deep insight. It's about South Africa and Cape Town. Yeah. The index, again, we collected a lot of data. We look at things from 3 dimensions. One dimension is the fintech industry, how big and how strong the companies are. Everybody is talking about the Ant Financial because it's headquartered in Hangzhou, in Zhejiang. So if you have big companies, that's important for you, whether you are hub or not. When you talk about the capital, whether you have been able to attract a lot of venture capital into the industry. The second part is really about the consumer experience. After all, financial services and the fintech, we are doing everything because we want the consumers to benefit from that. So consumer experience. And third dimension we look at is really the ecosystem, the business environment, basically. The macroeconomic factors, we look at the national GDP, we look at the population size, because it's important, okay? And we look at the economic growth rate. Is the economy growing? And we also look at the region. For example, in South Africa, in eastern part of Africa, or East Cape Town area, for example. Or, for example, in Shanghai, the great Yangtze River Delta region, for example. And then we look at the financial sector. Are there big financial service companies? Because they can innovate as well. And also, we look at the technology companies. How big are the tech sector in that particular region? And we talk about also the university. I'm a professor. We know that university can be important. So that how many top universities are in that region, okay, in that city? And then we talk about policy and regulation. Is the government supportive of fintech? How do they know how to regulate? How to create a conducive fintech regulatory environment? This is how we look at this. And the data we calculate, it's a lot as well. We look at 22 economic clusters in the world. When I talk about economic cluster, I mean it's more than just a city. For example, Silicon Valley is not just one San Francisco. It's like 9 cities. So we consider that as an economic cluster. We look at about 35 so-called cities or municipalities. So San Francisco would be a city or core city within that economic cluster. And the data, we used a lot of data, and we did a lot of calculations and the weightings. We talked to the experts, are telling us whether this weighting is more important than that one. And this is the map we have. You probably couldn't see this. It's a world map. It gives you a lot of names. For example, Greater London on the left top. You will see why I call Greater London, because it's an economic cluster. It includes Oxford, Cambridge, so that triangle. And Greater London as an economic cluster is number 4 globally. But as a city, London itself is number 4 according to our index. Okay, we can always argue. And if you come to further down to the south, for example, Sydney, Greater Sydney area is number 7 globally. And if you go to, say, Greater New York is number 5 according to our calculation. And New York City, or Greater New York, is number 6. New York City itself is number 5. Okay. I know it's confusing, so let me just show you the specific rankings with the table. The global fintech hubs, the economic clusters. What you will see is that these are what I call global fintech hubs. That means they have a global implication in terms of global leadership. What I don't want you to know that I was not being objective, but what comes up the first is Yangtze River Delta, as Dr. Jia Juicy knows, which includes Shanghai, includes Hangzhou, includes many big cities in one particular part of China. They come up as number 1, 81 out of 100. Number 2 is Silicon Valley. It's very close, to that. It's about 80. Then you have Greater Beijing, which Beijing, Tianjin, a few other cities. It's number 3. Greater London, as I mentioned already. Number 4, Hong Kong, Guangdong, Shenzhen, Canton area as a whole combined is number 4. Number 5, Greater New York is number 6, but they are all very close to each other. So 3 are in China, or Great China. 2 are in the US, 1 in UK. People probably, especially in John, you're from Germany, you might be disappointed that continental Europe didn't actually do too well in this ranking. And the second part is the regional, what I call. You have the global ones, then you have the regional fintech hubs. You have Greater Sydney, you have Singapore, you have Great Boston, you have Benelux as an economic cluster. That means Belgium, Netherlands, and Luxembourg. Greater Tokyo, Greater Mumbai from India, and then Greater Sao Paulo from Brazil, and Greater Paris, and Israel as some emerging. I wouldn't call emerging. I think Switzerland and Greater Frankfurt and Berlin, they should be, in the regional fintech hubs as well. And in terms of specific cities, I don't want to bore you with that. And what you will see is that, for example, for Beijing as a city, it's ranked number 1. But if you look at, in terms of fintech ecosystem, ecosystem, Beijing is also number 1. But for example, San Francisco as a city is only number 8 because it's less than 1 million people for San Francisco as itself. But if you look at Seattle, for example, it's number 10. It's not known as a financial services, center, but because of the technology, Amazon, Microsoft, all these companies, so they are coming up very strongly. While the traditional financial centers like Tokyo or Hong Kong, they are not doing as well as they, like Shenzhen, for example, as new and coming. So that's what. And as a summary, total global leaders, top 7 regional leaders, we have between number 8 and 20. You could see that the numbers are actually a pretty significant difference between, for example, number 7 is Shenzhen, which is 73, while Sydney, which is number 8, it's only 58. So there's a clear difference there. And the emerging leaders as well. I'm given a time difference, not time constraint. I'm not going into the details. So you have a few reports there. What I'll do is that I go straight to Africa so that Jaya can comment. Beyond the top, global economic cluster, you have a few others which are not in the top, like Chicago in the United States or Seattle, as I mentioned. Or you have Cape Town and Dubai, which are closer here. For example, Cape Town is ranked number 29 in our current rating. We would welcome your suggestions. So how did we come up with Cape Town, for example, as a sample? Its total index score is 19. And from our perspective, is the key advantage for South Africa, for Cape Town, is, first of all, the whole financial system is open in many ways. Secondly, South Africa as a hub for Africa potentially. You have 1.2 billion people, just almost the size of China, but which is suffering similar constraints, which is a financial repression at one point. So this is probably the biggest opportunity and advantage for Cape Town, for South Africa. Yeah, that's the opportunity. But obviously, your challenge is also, because relatively speaking, South Africa itself, you have only 50 million people. It's smaller than even Zhejiang province in China. So that's where your constraint. So that's why the regional integration for Africa as a whole. So today's topic, whatever about African development, I think is important. It's important. And the conclusion I want to say is that, first of all, because of technology, the FinTech is introducing a new global world order of FinTech. Secondly, interestingly, Asia and America seem to be leading, while the UK is also a very significant player. Europe, the continental Europe, seems to be falling behind, okay, compared to the traditional financial services. And we believe that for the first time in our recent history, the developing markets may be leapfrogging the developed markets. So that's why I think, Latin America, Brazil, I think Africa, Southeast Asia, they are fertile grounds for new financial technologies. And because of the FinTech, we have always been dreaming about inclusive finance. Because of the FinTech, I think the inclusive finance dream is closer to reality than ever in the past. And that concludes my so-called commercial here, which is AIF, Academy of Internet Finance. We believe we are an ecosystem. We have an incubator. We're running incubator. We're doing some exchange programs. So we'll be most happy to further expand our partnership with HSRC and Nelson Mandela University, also our partners here as well. So this concludes my so-called launch. Okay. Thank you. And I'm not going to do all the talking. So what I will do is that I will ask Dr. Lee, Wenwei, to spend the next 10 minutes about our project. Okay. And because we have been working with Krish on this FinTech in Africa project. So please.
Thank you, Professor Ben, and thank you all the dear ladies and gentlemen. And it's my great honor to give this speech here to talk about the FinTech strategies for bridging digital divide in Africa from a Chinese perspective. And in today's speech, and I would like to include following 4 parts. First of all, it's global FinTech landscape. The second is the FinTech development in China. In the third part, I would discuss how FinTech would help China to close digital divide and to promote financial inclusiveness. In the fourth part, I would like to introduce the financial regulation about FinTech in China. Well, regarding the global FinTech landscape, I think Professor Ben just actually launched our global FinTech Hub Index just now. So I think I will just quickly go through this slides. And as we might know that according to the Global FinTech Hub Index released by the Zhejiang University and Beijing, San Francisco, London, New York, Hangzhou, Shenzhen, Sydney, Singapore, and Seattle, among the most important FinTech hubs globally, where Cape Town is ranked at the number 29th, and as Professor Ben just presented. And when we're looking at the pathway of the FinTech development, we think that FinTech actually went through 3 stages. For the first stage, that's what we call FinTech 1.0. That's the FinTech IT stage. That lasts almost like 50 years until in the new century that we have the internet finance and the online payment, crowdfunding, and peer-to-peer lending. And until now, we're gradually moving into the FinTech 3.3 stage. That's we so-called the smart finance. And in the next slides, I will give you a brief introduction about the FinTech development in China. And when looking at these slides, I would like to say that according to the statistics by the last year, 2017, China's internet penetration rate is just over 50%. This is lower than the 89% in US. But when looking at the huge 1.4 billion population in China, it's sheer scale. That means there are 3 times of the number of the smartphone users and 11 times of the number of mobile payment users in China than in US. And when looking at the FinTech investment in China, and we can see that the investment peaked in 2015, and after that, due to the strengthening government regulations in FinTech areas, actually the investment dropped to the 64.7 billion Chinese yuan in 2017. But we see actually a very interesting rebound from this year, past 6 months, and we have also seen an increase in the investment in China. And for different stages in the FinTech investment in China, we can see most of the investment actually focus on the angel round and also A round. There are almost over 3,000 cases in these 2 rounds, with a total amount of 67.1 billion and 44.3 billion respectively. And we're looking at all these giant Chinese FinTech players. And we have the financial, like Tencent, Baidu, Jingdong, and Ping An Bank. And we can see these Chinese FinTech companies are playing across the entire FinTech value chain. And all their FinTech business actually serve to strengthen their core business. And when talking about FinTech in China, everyone's first impression must be the mobile payment. Yes, mobile payment is quite successful in China. So during the past 5 years, China's online payment industry enjoying the high growth of almost on average 69% per annual growth during the past 5 years. And in particular, in 2017, the transaction volume of the mobile payment in China hits 15.4 trillion US dollar. That's huge. And this number is forecasted to reach 25.9 trillion US dollar by the end of this year. And in terms of the market split, we can see the Alipay and the WeChat Pay are quite dominating and taking almost 92% of the market share, and while other payment companies are sharing the other 8%. So there's a wide discussion about whether these 2 companies are becoming too big and to fail in China right now. And because of the fast growth of the mobile payment in China, actually the Chinese people's life have become much easier and much more convenient in ever past. And you can easily just check out at a convenience store by just scanning the QRS code. And you can easily buy a train ticket at the train station using your mobile phone. And also even at the street food place, you can pay with your mobile. And also you can easily share a dinner beer with your friends just using Alipay. And the other fast-growing area in Chinese FinTech market, that's the artificial intelligence, we call AI. But according to the statistics offered by the Tencent Research Institute, the China's AI development still falls behind the US. And as of June 2017, the US was still the home of the most AI startups in the world, with almost over 1,000 companies in US. But China actually got a very ambitious plan to catch up in the area of artificial intelligence. And in July 2017, China's State Council released its roadmap to create a domestic 1 trillion Chinese yuan AI industry by 2030. And the large internet players like Baidu, Alibaba, Tencent, and FINTECH are the driving forces behind China's AI advancement. And also, regarding the blockchain technologies, as most of you might already know that Chinese government says no to cryptocurrency already, and they are said yes to blockchain technology. In September 2017, the Chinese government, led by the Chinese Central Bank, they banned the so-called the initial coin offering, the ICO, in China. And in January this year, and the Chinese Central Bank also ordered the financial institutions to stop providing fundings to cryptocurrency related businesses. So actually, they started banning the cryptocurrency trading in China. But to blockchain technologies from both the national central government and to local government, actually a lot of good policies have been issued actually to encourage the development of blockchain technology, and a lot of we expect a lot of these application business use cases will come up. For example, the healthcare records keeping and logistics and supply chain and digital asset tracking. All these areas will have more business use cases. Well, we have talked a lot about the fintech development in China, but how fintech helped China to close the digital divide and to promote the financial inclusiveness in China. And we can see from here that during the past decade, the Chinese government's efforts to improve the digital infrastructure in China have significantly increased the penetration rate of the internet, in particular the mobile internet in China, and reducing the digital divide. As we can see, by the end of 2017, the internet penetration rate in China has reached 56%. And among all the internet users, 98% of them are also mobile internet users. Large mobile internet users provide great business opportunities for many fintech companies like mobile payment and other related business. And regarding the rural areas, rural China, and the internet penetration rate has also increased from almost like only 7% in 2007 to 35% in year of 2017, only in 10 years. That's a very remarkable achievement. And also, fintech helps China to promote the financial inclusion by using the digital technologies, and the fintech is able to increase the financial inclusiveness by increasing the availability of the financial services to those people who were discriminated by the traditional financial institutions, and also to expanding their access to financial services which were not available to them in the past, and also by using, like, due to the low demand for physical like branches, and because offering the financial services are online, actually reducing the demand for physical branches. Actually, also the use of like big data analysis in the credit risk analysis actually also reduces the cost to provide financial services. And to guide the healthy development of the digital financial inclusion, and during the 2016 G20 Hangzhou Summit, the G20 high-level principles for digital financial inclusion, which is aiming to foster the development of digital financial inclusion, were approved by the global leaders. And we have some statistics here that how fintech empowers rural areas in China. And in particular, I think for e-commerce, that particularly for our guests from China, you might heard about the term called Taobao village, Taobao Cun. In many rural Chinas now, they have actually empowered by the e-commerce. That by the statistics of 2017, there were already like over 2,100 Taobao villages in China, and accounting for 490,000 active online shops. and creating annual sales of over 19 billion US dollars and creating more than 1.3 million new jobs. This is very remarkable. And similarly for education and news and entertainment. And well, so far we have talked about a lot of the benefits and the good sides, the bright side of the fintech. But what's the downside? What's the risk? As you can see that because of the faster growth of the fintech and also because of the lack of adequate regulations, supervisions, the risk associated with fintech business, for example, like fraud risks in peer-to-peer lending and also in all these cryptocurrency ICOs, and also like personal information security issues, and also like some of these kind of systemic risks, as we discussed, are also rising in China. As we showed a diagram here that is actually showing you that the number of problematic platforms, peer-to-peer lending platforms, as to by the end of this last month, that the number of accumulated problematic platform has reached 4,347, and the involved loan balance with these problematic loans actually reached over 41 billion Chinese yuan. So a lot of investors' money actually just become nothing. So that's actually a lot of risk. So this is the current structure of the China's fintech regulatory framework, that we call it as actually a mixed model of regulation, which is a bit different from like the regulation in US and the regulation framework in UK. That we have the multi-institutional separate regulation from a government side, and also we also have like the industry like the regulation associations as industry self-regulation as a supplementary. And as this diagram shows that in March 2018, the Chinese Banking Regulation Commission and the China Insurance Regulatory Commission will merge to create the new China Banking and Insurance Regulatory Commission. So we have actually new three structures. For the Chinese Central Bank, the People's Bank of China, PBC, the supervising the online payment and fund transfer related businesses. And for the China Securities Regulatory Commissions, they are overwatching the crowdfunding, online investment, and related issues. And for China Banking and Insurance Regulatory Commissions, they're overwatching the peer-to-peer lendings, online trust products, and online the consumer finance and online insurance. But actually, in terms of the operational, when coming to the operation, actually lots of these regulatory duties become to the local financial affairs office. Actually, this actually also created a lot of problems I would mention later. And we also have the national and local internet financial associations acting as the industry self-regulation regulators. And we conducted a research to the fintech regulation in China earlier this year. And we actually find that Chinese regulators are facing 5 major challenges when regulating the fintech companies. The first one is a lack of legal support and policy tools. That's a very big issue. They don't have enough animals to actually fight against the risks. And the second challenge is a lack of technical know-how or skills about fintech. A lot of these, the first line actually regulators, they have no any clue about the fintech. The third challenge is insufficient manpower funding to local regulators. The fourth challenge is actually the segmented financial regulatory framework in China often led to insufficient coordination among different regulators. There's a gap. And also they found it very difficult to collect evidence and enforce law across different regions. And therefore, innovative regulatory approaches are discussed and needed, and also discussed and tested in different parts of China. For example, regulatory sandbox and think RegTech, we're talking a lot about, and also innovation accelerators. Well, to conclude the speech, and I actually summarized the presentation to these 4 points. I don't want to actually just repeat them. And in the end, actually, I think I want to just use a famous quote from Nelson Mandela. Actually, I think it's also very suitable today because we're having this conference at this Nelson Mandela University. Actually, the quote says that it always seems impossible until it is done. I think this is exactly the way that how fintech is developing. Okay, thank you very much.
Thank you. Thank you, Wang Wei. I know we were rushing a little bit, given we have a lot of panelists. And China's story isn't 100% satisfactory because all the challenges we face as well. The fintech regulation, in particular, is a gap we need to fill. Okay, so Krish, we talked about we have been working together, and Wang Wei has given you a kind of like a balanced a picture about fintech experience in China. What do you see for Africa in terms of the fintech revolution?
Shall I run through my slides?
You have slides, right? Okay, sorry.
I didn't realize. Sorry. Okay, thank you, Professor Ben, and thank you, everyone. What I'm going to present today is the flip side of this project, where Wenwei has discussed the Chinese implications and lessons for us to consider here in Southern and Eastern Africa. I will look at the experience from Southern and Eastern Africa, and we'll probably see some correlation in some of the ideas, particularly those last few points that Wenwei discussed about regulation. I think is extremely important for us in Africa, where we are we're not as mature with our systems as the Chinese model has been through this quite extensively. The presentation that I'd like to work through is what's the rationale behind this project? Why do we talk about financial inclusion so much? What does it mean to us? I'll look at the country-specific context. For our study, we're looking at South Africa, Botswana, Tanzania, and Kenya. So I look at some of the background of those countries and what the trends are in these particular areas. I look at what are the drivers of change that we need to consider. How will this improve financial inclusion? What have been the barriers and the challenges that we're experiencing? And what are the recommendations that we can come up with that will take us forward? So in terms of the rationale, there's this idea of leapfrogging, which has come up quite often today. So what we find is African countries are well suited to adopt fintech technologies. This will allow us to leapfrog over that expensive infrastructure that needs to be invested, expensive branches that need to go to these remote areas where it's difficult to actually get access to services. So fintech provides opportunities for financial inclusion to a much greater extent. And perhaps this can then alleviate the effects of poverty with improved saving, more improved formalized business models, and then also empowering small businesses as well. But when we talk about financial inclusion, there's many different definitions which are actually in play. It's based on what the particular country or the institution is trying to drive. But what the World Bank has actually said in 2014 is that they defined it as the proportion of the population, including both businesses and individuals who access and use financial services. So the key idea here was access and usage. So here with greater financial inclusion, it promotes poverty alleviation and transforms the informal sector to become formalized to a greater extent. And then this has been recognized by quite a few international bodies, and in particular the G20 over the past few years has repeatedly reinforced the ideas behind the importance of fintech initiatives. And as I said, it's important for us to look at both the access dimension and the usage dimension. But when we talk about usage, we need to think about a few other supporting factors. How accessible is it? How affordable is it? Are the technologies appropriate? What's the quality behind the facilities that we are providing? Do we have sufficient financial education to understand how to make use of these services? How innovative is the product? How diverse is the product? How simple is it to use? Various factors that need to be considered, which help influence the level of usage of these products. And when we talk about how many people are banked, the surprising statistic is half of the world's population don't have a formal bank account. Only 24% of adults in Africa are formally banked. Access to bank accounts does not automatically benefit the poor. So in South Africa, we have the case where 70% of our population actually holds a formal bank account, but somehow the majority of the people still prefer to transact in cash. Why is that? So if we look deeper at some of the stats behind financial inclusion, you actually find that African countries feature quite high in the list of the most financially inclusive emerging markets. Kenya is number 1, South Africa is number 5, and this is based on the number of banks. So even though we've got high access, it's how does this translate? What is this doing to actually alleviate poverty? And so we're not really seeing these stats really translate into true benefits to the people. So one of the key issues we need to think about is not just the access, not just the adoption of the product, but are we using this product sufficiently, and is it being done so in a sustainable manner? So in South Africa, there was a study that was done, and it looked at the various types of services that can be conducted financially. So we look at what's offered through your transactional accounts, and then we look at other products such as credit access, insurance, savings. And in South Africa, we have a high adoption of transaction accounts, but in terms of credit and savings, we're actually doing quite poorly. Similarly for insurance, so we're not transitioning from the transactional space to the credit space to the savings space. And this is particularly difficult for people where their income is irregular. How do you pay for fees if your income only comes in sporadically? Savings is particularly challenging, and then the high transactional fees is an impediment which prevents people from actually using their facilities to a greater extent. So if we look at the 4 countries that I mentioned, South Africa, we're known for having a world-class retail, commercial, and corporate banking sector. The top 4 banks in the country have 90% of the market share. 70% of our population are banked, but there's a term that's used, the majority of us are underbanked. So even though we have the banking facility, we're not using it to the best that we could. And we have just limited basic service payment options, but we haven't really spread out into the wider array of products that could be used. In Botswana, the economy is dominated by the government and the mining sector. It's a large country, rural in many areas, and it's very sparsely populated. And the issue of distance is quite critical because this impedes access to bank branches. But similarly, we have lesser percent of people that are banked. But if we look at the stats on literacy, it's a very literate country. So the opportunity is there for mobile money to gain greater traction in these countries. Kenya and Tanzania have a similar story where both are promoting mobile money efforts. Financial inclusion is quite high in both countries. And the rollout of agents has been particularly effective to bring in larger numbers of the population to adopt these technologies. But the focus here again has been on payment platforms and less so on the other options, the other types of products. If we consider what has been the effect of the mobile money options which have taken effect, particularly in Kenya and Tanzania, let's just look at the Kenyan example and the South African example. The dark blue line, that talks about where someone is banked at a financial institution only. The lightest blue, that's where there's a combination of a financial institution and access to a mobile money account. And then the other blue is where it's just a mobile money account. So it's a sharp difference between the Kenyan example and the South African example, where here we were focused on the traditional banking options, whereas in Kenya and Tanzania and other countries, it's pushed along by the emphasis on mobile money. So mobile money really has been a strong driver of financial inclusion, particularly in Eastern Africa. But then the question arises, why is it successful in one area and not so successful in other countries, particularly here in South Africa? M-Pesa was introduced by Vodacom, as it was in Kenya, but when it came through with a bang in Kenya and Tanzania, it wasn't successful and actually failed here in South Africa. And the question is, why is that? Why what are we not doing? What are we doing differently here in South Africa compared to Kenya and Tanzania? One issue is regulations. And perhaps when we introduced these products, they were more targeted to the more affluent portion of the population, and less so as the experience might have been in Kenya, where it was a service targeted to the poor, meant to benefit them. And in Kenya, in particularly, these services were ubiquitous. You could, wherever you went, the M-Pesa tool was accessible and available. In South Africa, it was only in a few places where you could actually pay for services using this particular tool. And then the last point is actually knowledge about the product that's there. Not many people understood what this offered to them, and it tended to fizzle out. So when we talk about mobile money, some of the things we need to consider is, one, it's a driver of financial inclusion in Kenya and Tanzania. It's helped us overcome the challenges in the rural areas in particularly, but still product usage is low. The emphasis has been on payments and less so in the credit space, in the savings space, in the investment space, etc. In South Africa, mobile money had to compete against the major retail banks, and this was a factor in it failing here in this country. When we talk what drives change, what influences the change in these countries, there's these 5 factors which come up in the literature. One is the issue of disintermediation. Here we have less of a dependence on a middleman. So the institutions which are able to provide the same service that a traditional bank would is offering benefits to people, and then that starts to drive change. Dematerialization, where less dependence on a physical structure and you're moving to an online presence, is a further evidence of changes in the sector. Convergence, you start to see the business models of the mobile network operator and the bank start to converge. They have this common space, and now where the mobile network operator is actually the one driving these products, and less so from the space of the traditional bank. Then you have these disruptors which are entering the market, and they're turning the market on its head. And similarly, it's the mobile network operators that have this opportunity, given their large access to data and other things about their consumers. They can bring in new products, which can then lead to more changes. And then blockchain, using these new technologies has been particularly useful to migrate the distributed ledger format. And this will also, it ties in with the first point of disintermediation, where there's less reliance on physical structures. So in terms of financial inclusion barriers, on the supply side, it's that issue of high interest rates and fees. We're providing services that might not be exactly in line with what people actually require. And then the issues faced with using paperwork, it's quite slow, and then it becomes frustrating, and then traditional services are used to a lesser extent. From the demand side, informal economies don't have much data about it. How do we provide a service to a sector of the people where there's less information about it? This is a challenge, particularly for fintech startups that don't particularly have direct information about the sector that they're trying to transform. And then irregular income, the point I mentioned earlier. If your income comes in sporadically, how do you make payments to a service on a repetitive basis? And then issues of financial literacy. You need to understand how you are working with these products to gain from it. Then there's structural and regulatory issues. This refers to the lack of proportionate requirements to bringing people on board to these new products, lack of a regulatory framework, and so we could benefit from the example from China. And then a particular problem is the identification systems. We need data about people. We need to understand where they are. We need to build the databases for identification, which will then help drive the way we onboard people particularly. In general, some other issues we need to think about is what are the adoption rates for the products with low usage, and then also what is preventing women in some contexts from getting greater access to these technologies. When we talk about barriers, I just want to touch on 2 points before I close with recommendations. When we talk about regulations, the regulatory frameworks in some countries are at a very early stage of development, and so we could benefit from the Chinese example. But we need to have that balance. We need to mitigate risks on one hand, but also promote innovation. If we're too restrictive, we're not going to be producing new products which benefit people. The South African example has been found as one where we tend to be reactionary and not proactive. So we react to something rather than thinking ahead about what is required in our particular context. If we look at women's participation, an interesting stat which came up in some of the African countries was that in the formal context with a formal bank account, women's access was lower across various countries. But from informal access, they started to see a greater demand from the women to actually use these type of products. So there's a need that's there that hasn't been met from formal structures. And then my last point is one of affordability. If you look at bank fees in South Africa, they're 4 times higher compared to Germany if you look at your disposable income versus your average bank fee. So why are we 4 times more expensive than Germany? And then those with the low and irregular incomes are unable to afford the services in their particular country. And we've got to think about the types of tools that people are using to work with this. There's access to smartphones, and then there's access to 2G phones. In African countries, we're dominated by 2G phones. So we need to have tools which can be accessed based on the technologies available. So my recommendations that I end with is that our fintech operators need to align the supply of services to the demand. And so the supply of we need to look at the network, the service that's offered on these networks, the devices which can then use the service provided. We need to look at then the applications which then make use of, which are aligned to those devices that are used. And we need to value usage above access. I think that's key. In terms of those various factors that I mentioned earlier, our regulation needs to be more proactive, less reactive. And perhaps we need to think about rolling out products in stages. One where we look at connectivity and access, then we move on to online payments, which has been identified as a gateway product. And from there, we could go to credit, to savings, to insurance, and then to more ubiquitous access and coverage across the population. Thank you.
Thank you very much. I know I'm sorry I was rushing everyone because we have a lot of speakers. I didn't realize, I thought they didn't have a slide. So next one, that's the guy from Kenya.
I have requested 8 minutes per speaker. Thank you.
Ben, thank you very much. No worries, I'll take 5. It's been a long day. I know you're very tired. Mine is just to describe the situation on ground in the perspective of a Kenyan fintech company on ground. I have some slides. I don't know if someone can help me out.
Just escape that.
Yeah.
Right. Okay. Thank you. So allow me to run through the definition of the problem in our perspective, in our point of view. Suggest some, a solution like Circle, which is our product, and describe it and how it works, how it's working in the markets. We'll also go through the kind of opportunity which I know everybody's touched on if we support this kind of solution, and a few recommendations according to me, and see what we can do to promote savings and investment in Africa. According to us, we looked at the challenge of endemic poverty in Africa from a savings point of view. When your savings are low, your financial institutions are weak. And when your financial institutions are weak, naturally, there will be no money in the economy. So you're depending on short-term debt, which is often very expensive, and it also is mostly spent on consumption, so not production, not productive activities. And therefore, you cannot create wealth in this sort of system that where it's unsustainable. Unfortunately, that's where most of our countries are in Africa and emerging markets as a whole. What do we think can be done about this? We think it's a step back even further. Before you have to save, you have to understand the importance of saving. We think we have to go back to the drawing board and learn about money, to learn about money differently. Financial literacy is number one solution according to us. That's what we've seen on ground. Everything else is slightly more trivial. Once you've understood how to handle money more proactively and not reactively, then you need more affordable, user-friendly financial services, not the short-term debt that is expensive. The cheapest capital is usually your savings. So, you know, when you borrow from yourself, you won't charge yourself interest. And that's where these kinds of products come in, after you know a little bit more about money. So when we were looking and thinking about a solution to all this, naturally, we thought about your mobile phone. That's a very conservative figure. There's more than 700, 800, maybe million people with a device, a mobile device that's active. And we have the technology to use it to extend innovative financial services that are tailored to you. The examples have been given. Krish has covered the high-level stuff about how the mobile phone is very powerful. In Kenya, about 90% of the country has been included in the financial system. That's the power of your phone. And we have used that thoroughly. What is Circle, this thing that is on my slides? Circle is our product, flagship product. In 2013, we emerged as Africa's first entirely virtual savings and investment platform. In Kenya, savings, well, the Kenyan market accounts for about 44% of our total usage. I saw in Krish's slides, Bangladesh is also using mobile money, and that's our second largest market at 22%. Circle is active in about 8 countries, but live in about 143 countries, and we're still going. What does it do? It's, I think, the only app that I know that can let you save with your family and save on your own at the same time, via mobile money, via your bank card, and virtually from anywhere on the planet, because the technology is available. Prof. Gomez can even tell you. And when you're saving, of course, you'll get your incentive for saving, just like you save traditionally. We offer bonuses every time you save, and that actually incentivizes people to save, because saving is not easy, and that's because people don't know the importance of saving. So we've, experimented with instant gratification, instant incentives like bonuses, and they've had a very positive effect on people's mindset about saving. And of course, the transparency that comes with viewing everything on your app, all your members, all your transactions, and seeing your money grow right there and then. It has, unmatched kind of trust positives. What's the opportunity? Right now, about 64 million people in sub-Saharan Africa alone are eligible to use a product like ours. via mobile money. They have an active balance on their mobile phones, which means every day or every other day they transact with their mobile phones. But there's something nobody's mentioned today, which is the large market in diaspora banking. 30 million Africans are sending money home. But that 30 million might be small in Chinese numbers. But in Kenya alone, just 2 months ago, about $232 million was sent home in 1 month. That is probably the largest income earner for the country, diaspora remittances. And what is this money sent back home for? Most of it is sent back home for investment. This is why we're talking about saving and investment hand in hand. When you save money, it shouldn't just go to, again, consumption. It can be used for productive activities. It can be used to create wealth. And that's why Circle has been designed to allow people to leverage on their personal contacts, their personal networks, to grow their savings and create wealth. By the end of this year, and this is just in a 2-year lifetime of our product, well, we've been developing it for the last 5 years, about 3 million people will have access to our service across Africa, which is a small number again, but it's about the value. It's about the value of deposits, and we're still going. And that's a case study or something going on ground. Okay. Well, in my opinion, what can we do? A lot of it has already been mentioned by the other panelists and the other speakers. Promoting financial literacy programs I've already spoken about. Updating and aligning international financial regulation. Encouraging fintech and regtech innovation through incubator and accelerator programs. Regtech is very important because regulation must be updated, must improve at the pace of the innovation. It's a very big challenge, but if you explore technology, you'll find solutions to update regulations so that we can be able to provide these services at a low cost. Fostering partnerships goes without saying. Consumer data protection, very important. Our consumers need to know that their information is safe. And funding and investment opportunities to grow successful, sustainable businesses in financial services, in banking, is also a very important thing. But it's not the first. It's important, but it's not the first. So I'll end by asking a question that, might just seem cliche, but everybody has a role to play. You've noticed that these things matter in different sectors, in different industries, in health, in insurance. When we're talking about money, we're talking about life. What is your role in promoting savings? What's your role in promoting economic development in Africa? Whether you're the BRICS, the UN, World Bank, whoever you are, think about your role. I've explained mine. Thank you.
Thank you. You used exact 8 minutes. Thank you. Okay. It's yours, okay?
Hi, everyone. Amazingly, I think most of my points have been covered by earlier presenters, but I will, in the interest of being and looking useful, will try and cover some things that they didn't mention. Sorry, I'm Kim Kariki, I'm from Busara. We delve in behavioral economics and we look to try and understand how perception and context influence how humans behave. As I was sitting here, I just thought to myself how hard it is being a Kenyan. I don't know if Patrick has the same impression, but it's really hard to come to South Africa and have something to best South Africa. It's not rugby, because you guys beat us on rugby. It's oftentimes not corruption, although in recent memory. But financial inclusion, yes, I think I'm quite proud of the strides that my country has made. But I want to use a different slant. I want to talk to you not so much about the structural bits. I want to talk to you about the behavioral bits, the things that Busara does, and to help us prime this, just for you to remember that we're designing financial inclusion not for robots we're designing financial inclusion for people, for real human beings who behave in certain ways that is predictable. So before I get ahead of myself, let me just jump a few slides and talk about these behavioral factors. So my colleagues have talked about the structural factors, the things that, if exist, will drive and help move financial inclusion forward. But oftentimes what is overlooked is the fact that we're designing for people. People behave in predictable ways. And if we understand how they behave, we can design better solutions and we can promote financial inclusion. We can move faster. Let me give you an example that probably brings this point home. As I left to come to Johannesburg and then eventually Port Elizabeth yesterday, I got to the airport with my suitcases and I was getting ready to enter the airport, and it hit me, oh no, I had forgotten something. And what I had forgotten, unfortunately, wasn't my ticket, wasn't my yellow fever certificate, wasn't my passport. What I had forgotten was my credit card. I was like, oh no, I forgot my credit card. And I thought, oh, it's okay, I'll have my mobile money. I thought, oh no, I don't know if mobile money works in South Africa. Now, all of this is very rational because I carried enough cash, or at least I think I carried enough cash, knock on wood. Let's see if it survives the shopping spree. But I felt that I had enough money in cash. But because I'm financially included, I've set up a new default for myself. That my new default are my financial instruments, my credit card, my mobile money. And so this is what we're saying in terms of behavioral factors is, if we can create new defaults, it is actually possible to move financial inclusion forward. We can get as many as 235 million farmers and 100 million welfare beneficiaries included into the form of financial services sector. We're just helping them change their defaults, helping them not think about cash, helping them think about other tools. All right, so for this point, I want you to think about, for those of you who are privileged, it's a privilege now because we've all moved to the urban areas, but if you're privileged enough to think about you or to have a village back home, think about that woman in the village, think about that farmer, think about that laborer. And some of the behaviors that we found that tend to keep these people unbanked, or that are quite prevalent amongst the people who are unbanked, are a few things. One, they're generally averse to risk. They will not necessarily take a gamble on something, even though it has a decent chance of making them better off. They're fairly averse to loss. I'll give some examples so it becomes easier to follow. But they're fairly advanced to loss. They don't want a situation where they could risk something. Because their money is fairly tight. They're based, and the decisions are based in the future. I mean in the present, not in the future. So if they have their last 100 rand, they might think of how to fix the roof before thinking about saving for their children. There's what you call the status quo bias, which is, as much as they want things to change, they really don't want change. And that's, I think, we can all resonate. We want things to stay the same. We want our political parties to keep remaining in power. No, we want to stay the same. And then social norms. It's amazing how we underestimate the fact that as human beings, we all want to be like each other. We want to feel community. We want to feel like we're the same. It's what you call the herding effect. We want to feel like we're together, we're joined, we're united. What is the word? Ubuntu? Ubuntu, right? But then, secretly, deep down, we all want to be slightly better than our neighbor, right? What's the point of being just like my neighbor? I want to be, in fact, in Nigeria, there's a campaign that they've run for solar where they talk about better my neighbor. And so that's actually what's helping them drive optical solar products is, yes, you all try electricity, but better your neighbor, be slightly better, right? And there's this business about mental accounting where these households, these people have such little income, but they're trying to associate and plan every single coin to the last. And that's really hard to do. But because of these behavioral challenges that they have, we found ways and creative devices to help them design around these challenges. And I'll get to those and it'll become a bit more clear, hopefully. So let me do a shameless plug here for behavioral economics and say, this is slightly different from our traditional economics. I think all of us here would like to think that we're rational, and traditional economics has made us think that we're rational. But I challenge your rationality in this way. You know, all of you walked into this room, and aside from those who probably have been to the room before, none of you bothered to check if your chair will be able to support your weight, right? Because the rational thing to do would have been to actually test that seat and find out, can it hold my weight? And do that every single time you walk into the room. but there's some irrationalities that are built into our system. We don't have the cognitive root to do that. And here's another example. So Las Vegas is busy every day. So we know that people are in a rush, right? I mean, if it was truly the case that people are rational, we wouldn't be that busy. So behavioral science is helping us understand, what's really going on. Why didn't you check your seat when you walked into this room to see if you hold your weight? Well, you may be thinking that you've lost some weight, so you're like that, so you check and say, what? But mainly it's because we want to conform, right? There's a social norm. Who does that? Nobody does that. So I don't want to be the awkward person checking my seat. So these are things that play into the unbanked as they're making decisions. And those are things we need to understand if we're truly going to promote financial inclusion. And so all of this is, suffice it to say, our minds are a lot less independent than we like to believe. I like to believe all of you are just sitting here and listening to my presentation and enjoying it. But the truth of the matter is you're probably thinking, this is very preliminary, why do I need to pay attention to this? Or you're probably thinking, it's nearly time to end, why can't we be done already? There's a lot happening in our minds, and the decisions we're making is a function of all of these things that are happening. There's the environment, there's the memory, how much can you actually hold at any one given point in time? Now your peers, what are other people doing? There's motivation. You might be motivated to do something today, like to save, but you know what? You see a darling pair of shoes, and you decide you don't want to buy that pair of shoes. So then your decision is not supported by your belief. So these are ways in which we try to understand how can consumer behavior be adjusted to come to a goal that is actually in the best interest of this person. So I'll move to some applications in the real world. And so here we're trying to understand how we can improve this digital savings. And so we tried a couple of different things, and this was with informal workers in Kenya. We had them save 20 shillings a day, which comes up to around 100 shillings a week, assuming they work Monday through Friday. And we tried different ideas. One was just to send them reminders and tell them, hey, please remember to save for your future. Other ideas which said, and we tried is to say, hey, let's try and match however much you save. Let's try and put some messages in there about how saving is important for your kids. You want your kids to progress. You want them to move out of the township and live elsewhere. And then the last thing we did, which seemed fairly trivial, was just give them a gold coin. And at the back of the gold coin, they could write every week how much they had saved and what their goal was. And from the graph, you can see the coin was significantly more effective than all other interventions. It flies in the face of what you have thought traditional economics would say. Yeah, the fact that I'm going to give you money should really make you save more, but no. It was the fact that it wasn't even just really the coin. It was just the fact that the informal workers could understand and could see and could relate to their goal and their progress over time, and then their future aspirations. Because the truth of the matter is, all the decisions that we want the unbanked to make are important and they're good, but they're not always silent. A typical example is if you're gonna have 100 shillings in your pocket or 100 rand in your pocket, will you save for your child's education or will you fix it? So I'll just quickly run through the rest of these. Again, agency and trust. So this is on mobile money. So we tried to do some studies to figure out what is going to actually improve customer experience. And we found that if you make it more visible, more salient, how much each of these households are spending on sending money, you improve the experience. So before you send money and you've been clear how much you can actually be charged in fees. But just by making it clearer, you're actually being charged X% on every transaction. That improved the experience and that improved trust. And actually that helped drive greater use of mobile money facilities because people who are in control. I think the last one I'll talk about is how agency and altruism is helping to reinvent insurance. And this is not even from Africa, this is a different example from the US. But the whole idea is this: we all buy insurance, we don't quite like it, we don't like the fact that we pay money, we don't know if we'll ever get it back, and oftentimes when you do have a claim, you never get compensated. So what Lemonade has done is to say, okay, fine, yes, give us your money, but we will treat it like it's your money. And so if there's a claim, they will pay it quickly, but most impressively after that is if there's no claim, that money goes to the cause of your choice. And what's going on there? What's the behavioral insight? It's the fact that ultimately we are all fairly altruistic. We all want to help our fellow person in need. And so by making it easier, more convenient, we can actually drive that behavior. Cool, that's my time.
Yeah,
Yes,
well, sure. We'll save the best for last.
the difficult
I know
task
some time
of
depression.
being the last speaker. Okay,
Of course.
Jaya, I have.
And now that ruined my reputation, I usually can finish earlier. But I underestimated. I underestimated.
okay. So I have the difficult task of being the last panel speaker at the end of a long day, the only female speaker on this panel, and so I hope I can keep your attention for the 8 minutes that I have. A lot has already been said, particularly around fintech and financial inclusion. I'm going to speak a little bit more broadly in terms of how we can better leverage digital technologies for financing sustainable development, particularly around poverty reduction, unemployment, and inequality. So the problem statement is simple. It's how do we finance sustainable development? The UN estimates that over $90 trillion will be needed to finance achievement of the Sustainable Development Goals. While this number may seem completely unrealistic, it actually isn't. The problem is not that the money isn't there. The problem is that the money isn't aligned with Sustainable Development Goals. The size of the global economy was actually $75 trillion in 2016. Investment in Sustainable Development Goals will in itself create additional market opportunities. However, the financing is currently not aligned with these goals. The G20 from 2016, including this year under Argentina's presidency, has outlined a number of barriers that actually limit the mobilization of sustainable finance. These barriers include asymmetric information, as well as the difficulties investors face in identifying opportunities and internalizing the external costs of social and environmental issues. So digital finance offers a potential opportunity to address some of these barriers. Technologies such as big data, AI, mobile, blockchain, and the Internet of Things reduce the costs of transacting on the one hand. They unlock innovation and inclusion on the other. Digital technologies are a lot cheaper to process than traditional ones. We've spoken about financial inclusion, which then, banking, digital technologies have the possibility of banking about 1.6 billion of the current 2 billion people that are currently unbanked, and that in itself has been estimated to create about 95 million jobs and add about $3.7 trillion to the GDP of emerging markets. So there's certainly a huge opportunity in terms of digital finance. However, as we've heard about throughout the day, the problem around access and availability, those who benefit from digital technologies are those with access, those who will be able to come with intellectual capital, the innovators, the investors, the stakeholders, while those without access will not. And so there's also the risk of increasing inequality rather than reducing them. The way we've been, so the Sustainable Digital Finance Alliance, which I'm working with, has done a piece of research for the G20 Sustainable Finance Study Group, where we've done a mapping of practice across the G20 and private sector to try and understand how digital technologies are being used to increase financing for sustainable development. And we basically found that on the one hand, digital finance, through its data power, if you wish, its ability to make more data available more cheaply, more quickly, more accurately, really helps to create better information that helps to inform financial decision making. And on the other hand, as I said, it helps to increase inclusion and unlock innovation. So we've thought about this in terms of a pyramid, where at the bottom you've got the way digital finance helps to improve financial decision making, and so it makes it easier for financial institutions and investors to invest in projects that take into account environmental and social issues. As you move up the pyramid, digital finance helps consumers to make more sustainable consumption choices, which in turn will influence production patterns. It unlocks new sources of finance, so bottom-up sources of finance through crowdfunding and peer-to-peer lending, and matchmaking platforms that bring together investors and sustainable investment opportunities, and also these alternative credit lending platforms, which using alternative sources of data are able to open up access to finance for people who would not otherwise have access to such opportunities. And then at the top of the pyramid is the way innovation in the financial sector begins to interact with innovations in the real economy, and the way digital finance is able to unlock new business models in the real economy that then makes investment in these types of sustainable sectors more commercially viable. So there's been a lot of talk with our Kenyan colleagues on M-Pesa around financial inclusion. But if you look, in addition to financial inclusion, M-Pesa has created new business models. So from M-Pesa, you have M-Kopa, which through a pay-as-you-go model using your mobile phone, it suddenly makes it commercially viable to provide clean off-grid energy for poor rural populations that before M-Pesa would have just been not possible, simply not possible. Add to that M-Akiba, which is the new Kenyan government-issued retail bonds, which offers ordinary Kenyan citizens, they don't have to have a smartphone, the ability to save and invest in a government bond, very low amount, and participate in the infrastructure development of their country. So this kind of interaction between innovations in the financial sector opening up new business models in the real economy. I just want to share two very brief use cases. One is from China, of course, the Ant Financial app, Ant Forest program, which is really fascinating. So Ant Financial Services, together with the UN Environment Program, set out this pilot called the Ant Forest app, and basically the app tries to influence consumers to make greener choices. So it basically takes your, it provides you with an individual carbon account through your mobile phone, and then you earn green virtual energy points as you make greener decisions. So if you take the train rather than taking your car, you earn green energy points. These points can then be, there's a gamification angle towards it so that people are really involved. And at the end, when you've gained a certain number of points, an actual physical tree is planted in a desertification area in China. And so over 16 months, over 280 million Chinese people are actively using this app, which has resulted in over 2 million tons of carbon avoided and 13 million trees planted. And then in South Africa, a few examples about how digital technologies are unlocking new sources of finance by both crowdfunding channels as well as online payment platforms. So for example, PayFast is an online payment platform that has actually then allowed StartMe, which is a crowdfunding platform, to exist, because through PayFast, anyone from anywhere in the world, in South Africa and abroad, can contribute to entrepreneurs and community causes through crowdfunding platforms like StartMe. Just globally to share that we've seen a growing momentum in the space of sustainable digital finance. In 2016, the UN Environment published a report on fintech and sustainability. The G20 has been taking up the topic. In 2017, they launched the Green Invest platform, and in 2018, as I mentioned, the Sustainable Finance Study Group has been looking specifically at applications of digital technology to sustainable finance. The UN Secretary General will also be launching a task force that will specifically look at the role of digital finance in raising financing for all SDGs. A lot has been said on the challenges, so I won't dwell too much on them. Maybe just focusing on two key ones. One in terms of the limited knowledge and awareness right now. Digital finance is quite new. Sustainable finance is also quite new. So this nexus between the two is still very much in its early stages. And the second, I think, challenge is the silos that we currently see between different stakeholder groups. So you still have the fintechs on one side, policymakers on the other, financial institutions, and there really isn't yet this integration between the various stakeholders that's really needed to be able to leverage these solutions for increasing financing. And in terms of the opportunities, I think, we've kind of bucketed these into two lots. The first around being able to increase understanding and awareness through greater research. We're also seeing countries trying to establish these multi-stakeholder platforms that will try to bring together different stakeholders to identify what are the barriers at national level and how can these barriers be addressed. And we believe there's also room to really continue the momentum created by the G20 and the UN to look at cross-border issues, particularly for remittances, as was mentioned. And then the second bucket is really around promoting investment in specific solutions that help to drive sustainable finance. A few ways that these can be done. There are already vibrant fintech ecosystems. Integrating a sustainability element into existing incubators and accelerators is one way of doing this. It's also important to understand which are the solutions that are really working and be able to see how we can scale some of these. So I think Circle is a great example of that. And then as was also mentioned by Krish, this need to really look at relationships between fintechs and regulators in order to find that right balance between not regulating too much so that innovation is not stifled, but at the same time, not regulating too little so that there's risk to consumers. So I hope that was within the 8 minutes.
Thank you, Fiona. Thank you very much. Sorry we're running a little bit late. It's all my fault. But I can't let them get away without saying something. 2 minutes. Look, sir, from Turkey, talk about the fintech and the opportunities challenge. I have never been in Las Vegas, so you can rely on my words. So I'm a sort of an expert on cryptocurrencies. I already made my discussions, and thank you for joining me an hour ago or two. But let me add a couple of words on this topic. First, as I mentioned before, these cryptocurrencies is nothing new, and the machine that I'm holding in my hand is a electronic money transfer point of terminal. So it was supposed to transfer value from one smart card to another. It was made by Hitachi, the Japanese company, in 1994, I suppose, because there was a electronic money trial in the UK, at the town called Swindon, again 1994. That trial failed. Mondex failed, even they developed an operating system called Multos. And then there was an internet-based digital money proposal, which is called DigiCash. And it was such an advanced cryptography-based proposal. And at one time, I remember the value of the company was around $1 billion. And David Chang, his inventor, didn't sell to neither Visa nor MasterCard. But the company suddenly went bankrupt because the described tokens was not as unique as it was supposed to be. So that was a problem of publication. Recently, cryptocurrencies resurrected again. It is not because of Bitcoin, but there was always research on the topic. But I think Bitcoin become phenomenal. But let me complete the discussion with one example. From 1994 Sweden trial to DigiCash, there was no perfectly well documented successful implementation of electronic money proposals. Suddenly, China, when I was in Beijing in 2012, 2014, there was no electronic money at all. And suddenly, we heard that Alibaba is proposing a fund similar to money market funds, and they have an intention to allow customers to transfer value between their mobile accounts. I said, hold on a minute, this is a product I should follow up. And then WeChat suddenly jumped into the market as well. Within 2 years, it became possible not to carry any banknotes in your wallet in China. And it was a phenomenal, successful implementation or launch of mobile payments or electronic payments. I think the real electronic money is the one that touches us. I think I'm just next to a philosopher. He will explain the situation much better than me. But when you make a proposal, just read what people really want and utilize the technology perfectly. And please ask your government to give you the right instruments such as citizen identification number, access to internet technologies. There are certain requirements that you need to have before the launch of a successful electronic money scheme. I think that's all I want to say. Thank you for having me here. And Jaya, thank you for having us here.
Looks when you were working in Beijing, he witnessed the transformation. Internet financial revolution in China, basically. 2013 was considered as the year of internet financial revolution. We have all this Alipay, WeChat Pay, all these things, but it's not just all about them. FinTech in China has Lian Pay. Can you tell me a little bit about yours?
I'll stand up. Yeah. This is the final part, so I will finish as soon as possible. So guys will get to the gala as soon as possible, right? My name is Alvin, and I'm working with a payment company called Lian Pay in China. And you guys may not heard of it because we're struggling to survive in the 8% of our market share in China. And luckily, we're in the 4th position of China's mobile payment market share. And what I want to say is a brief introduction of what I'm doing, what the company's doing in China. So we're serving like over 20,000 merchants and companies in China, which brings us over 300 million users of Chinese users in China. And we all agree that mobile payments is growing very fast. I'm very happy to see that because that proves that customers loves us, right? And but you know, Chinese merchants, Chinese companies, they are creative, but also they are very tough. And you know, like day one, like, hey, Lian Pay, I want to make domestic payments. We say, okay, we'll have product. In day 2, hey, I want cross-border payments within 1 week. Okay, we can do that. When we provide the product, they say, hey, why there's not VAT services with you? They just say like that. Okay, we do everything for them. In the scenario like this, so we are focusing on fintech, of course. We have artificial intelligence on face recognitions, risk controls, anti-money launderings, and we have blockchain technique for supply chain finance. Also, we have some other fintech services. So everything just going really fast in China. But I know the Rome is not built within 1 day. I met several new friends here. I'm very happy. I knew something in Africa, especially in South Africa. So I believe there were 2 major barriers standing between us. One is that the mindset of using mobile payment and fintech technologies. because I remember very clear that in 2005, it was my first internet payment when I made to make a purchase on Taobao to buy a watch. This is my first payment on the internet. At that time, my dad would definitely not agree with me to make a payment through internet because it's not reliable. They don't trust it. You have to do it through banks. No mobile, no internet. But now my father himself is a merchant on Taobao on the internet. Can you believe that? Yeah, this is like 12 years mindset from my father. Yes, it's a change. Yes, and the second barrier maybe it's not a barrier. Maybe I don't know very well. Is the infrastructure setting up. There should be companies. There should be data warehouse, and there should be reliable and strong network for cell phones and internet. That's how we can do payments. You know, today technology is not the most important problem because China has the best engineers and the developers and IT guys in China. We have everything, studied. We have perfect products for everyone in the world, but there needs to be a proper environment for us to grow. So that would be something I would like to share. Thank you, Mr. President.
Thank you, Alvin. And thank you all the speakers discussing today. For Africa, China FinTech Dialogue, we have talked opportunities, but we also talk about challenges, the barriers, not just in industry, but also in regulation, in ecosystem, and in many other things, and even the mindset. But I think it is going to take place, just as it has been taking place in China. The revolution is coming, and I hope that Turkey, Kenya, Africa, South Africa, and the whole Africa will get the benefit of inclusive financial service and digitally. Thank you very much for joining us. Thank you, Professor Ben, and thank you, everybody, Professor Shane, and everybody for coming and participating today. But this project that we have set up between Zhejiang University, the HSRC BRICS Research Center, and the AIF, and we're going to try and bring in and Linden Pay as a partner. But the project is being funded by the GIZ. John Hurt, I'd like to thank you for funding the project. And I think to fund other projects for us, so that we probably need to draw in our colleagues from Kenya and from the UN also to become part of that project, so that we can benefit and see how we can extend and really make Africa inclusive in the FinTech project. So far, Ben from China and I from South Africa are coordinating, and Fish and Wenwei and Johnny and Eddie. Where's Eddie? Oh, he's there. He's from Ghana, and he's part of the project, but we can expand that, we can include some of these things. And with Linden Pay and perhaps your company and your company, we can perhaps make it happen in Africa to become more inclusive. So I thank you all very much, and thank you GIZ, and thank you everybody, and the HSRC for helping today to become what it is, and to AIF and CFI. So let's give them a big hand. And of course, there's dinner, gala dinner tonight, and there will be a guest speaker from Nelson Mandela University. And you make sure you enjoy yourself. And tomorrow, hope to see you again here in the morning. Thank you very much.
Just an announcement, everyone, that the gala dinner is happening at the Marine Hotel, and if you are staying at the Marine